Bonds are the risky asset, according to Leon Cooperman. All right, so let's read this. I already read it, and I'm just going to share with you my commentary because, anyway, let's just go into it. All right, this article is based on a presentation from John Malden's 2020 Virtual Strategic Investments Conference, which was held May 11th through May 21st. All right, if rates stay low, the returns on stocks will be better than bonds, according to Lee Cooperman. Bonds are the high-risk investment. Let's see. Cooperman is retired and previously founded and ran a hedge fund, Omega Advisors. He's a billionaire and philanthropist, having signed the Giving Pledge, a commitment to donate at least a half of his wealth to charity. The U.S. I freaking can't stand the Giving Pledge. This is why I want a wealth tax, and we're going to talk about it here in a second, because essentially these guys are saying a wealth tax will cause irreparable harm. It's not efficient, but they're doing that through this Giving Pledge. But we're not getting it now, and a lot of this money goes to freaking NGOs overseas who are up to no good. So I said, well, let's just get to the U.S. Treasury. You're going to give it away? Let's just do it while you're alive, man. Do it while you're alive. Give it to the U.S. Treasury so we can spend it to shore up in Social Security and Medicare. The U.S. stock market is reasonably fully valued, says Cooperman, not dramatically overvalued. One reason he believes it is not overvalued because its composition has 25% of high-tech stocks. Okay, does that mean only 25%? It means it's not overvalued. High-tech stocks are undervalued inherently, or high-tech stocks only represent 25% of the overall index, which keeps it from being overvalued. I don't know. There's a conundrum there. Which one is it? So I read this, like, that doesn't make sense. So again, one reason he believes is not overvalued because of his composition, with 25% in high-tech stocks. Are we missing only 25% in high-tech stocks, or are we saying high-tech stocks should be if we had more high-tech stocks to be less overvalued? I don't get it. If the market is appropriately setting interest rates, he said, that means you only make 2 to 4% on stocks. He based that on assumptions that the labor force will grow to 0.5% of 1% and the productivity will grow at 1.5%, producing 2% real growth in the economy. To that, he added 2% inflation, which would provide a 4% nominal return. He acknowledged that it will take several years to get to 4% yield on the 10-year Treasury. He said that a 4% yield implies a PE ratio of 17. Applying that multiple to 150 per share in S&P 500 earnings leads him to conclude that the market is fully valued. But we don't have a 4% yield. I don't understand that. So right now we have literally almost 0.5% of 1%. It's 0.61. Let's double check. Last I checked was 0.61. Let's see where it is. Hold on a second. Let's see where it's at the end of close yesterday. The 10-year 0.65. So we're at points. It's basically 2/3 of 1%. So if we have a 4% yield, that implies a 17 PE multiple for stocks. So if we have a 0.65% yield, wouldn't that imply a 30 PE? And we're far from that. So wouldn't that say the market is undervalued? Cooperman expressed deep concerns about the country's fiscal situation, which underlies his conviction that bonds are riskier than stocks. This is what I want to talk about. We already had a $1 trillion deficit before the virus. Someday this is going to catch up with us. Here's the critical one. If the dollar weakens and inflation catches up, the game is going to change. If the dollar weakens and inflation catches up, the game is going to change. And he's saying that about the $1 trillion deficit we already had. My friends, I quoted you a guy on, and I showed you this video. It didn't play well, but it's from Louis Rukeyser back in 1988, I think. 1987. And it's a guy from one of the wirehouses, J.P. Morgan, something I can't remember, Goldman Sachs. I think it was Goldman Sachs, actually. He was literally saying the same stuff. Literally saying the same stuff that these guys are saying. 1987, so that's 20 years. That's 33 years ago, saying the same exact stuff. It's insane. Then you go back to the 20s and 30s, and the newspapers were saying about the debt that the U.S. had is going to catch up to us. It might, but these guys are singing the same tune, and they've just been wrong time and again and again. If you follow these guys because you're an inflationary bug, like, oh my goodness, inflation is going to eat us alive, the U.S. is going to lose its value as a dollar. Man, you're singing from the same song sheet that they've been doing for decades, man. and you're just leaving money on the table. You are, if you're just following that. Look, I'm not saying don't own gold. I'm not saying don't own real estate. I'm not saying don't diversify, don't risk, hedge if you need to. But man, can you stop with these same things? I mean, it's just at some point we got to say it hasn't happened. It hasn't happened. Then we look to the evidence again of Japan and say, how do you explain that? But at their fully valued levels, stocks present risk. But he's saying they're fully valued if we have a 4% yield on the 10-year treasury. But we don't have a 4% yield on the 10-year treasury. So at their fully valued levels, stocks present risk. Well, it sounded to me like stocks are undervalued. This whole thing is just an odd article because he's saying bonds are risky. Well, but the whole thing is about stocks. That whole thing is just weird. I mean, I get bonds are risky if the interest rates go up. I get that, but this is it's just an odd article, and I wanted to bring it to you because it's just the same song. Oh, this guy makes $1 billion. He knows more than you because he's a freaking hedge fund guy, man. Is he creating value, or is he being like Bain Capital, Mittens and crew, putting people out of work, freaking taking on all kinds of debt and selling the shares after people lose their jobs? They bring all these HB1 visa workers in, and Americans lose their jobs. This is what goes on, and they sell it for free. It's just, these guys are just they're operating in their best interest, not the country's best interest. Anyway, for example, in the market structure, if the changes in the market structure make stocks more dangerous, the machines run the market. That's exactly what that guy said from Goldman Sachs. Algorithmic traders buy strength and sell weakness and exaggerate price movements. Without commissions and the weakening of the Volcker rule, there is more volatility. Cooperman said that 80% of trading volume in stocks is done off the exchanges. The uptick rule, eliminated in 2007, gave rise to high-frequency traders, which create unnecessary volatility. They said the exact same thing that Goldman Sachs guy. Just look up Wall Street Week with Louis Rukeyser. Maybe I'll try to link to it later on or do another video on it. They said literally the same stuff, while the uptick rule is still there. The machines know everything about price and nothing about value. Risk parity traders are usually using approximately 10 times leverage, and when they need to unwind positions, they must do so in aggressive fashion. That adds the unnecessary volatility. I don't know what has to do with bonds being more risky, but whatever. On the geopolitical front, he said we need to worry about China. It is being set up as a whipping boy, and we need to be concerned about that as an effect on the market. Yeah, because they are. They need to be the whipping boy. They've caused irreparable damage to the world. Now, on top of their own people who they're freaking murdering in the name of communism. Stock repurchase, which have buoyed prices, are over, he said. Profit margins are mean reverting and will head down. Buffett has difficulty figuring out, so there's no reason to be bold. Warren Buffett expressed concerns about deploying his capital in the stock market. Although retired, he still manages his own money. What does this have to do with bonds? Okay. Running a hedge fund with quarterly liquidity makes it difficult to have a long-term focus. Well, okay, sorry, but you still made billions. Cooperman recounted how he got involved in a high-profile spat with Elizabeth Warren. When Warren's presidential campaign was at its peak, Cooperman made what he described as an uncommon political comment. At an investment conference, this guy's a faker. I'll tell you why. At an investment conference, he said the Warren presidency would cause the market to go down 25% or even worse, not open the next day. She responded that she was only asking for 2% of his wealth. He responded by writing what he called a respectful letter explaining, among other things, his opposition to a wealth tax. Of course he did. She responded, he called Warren a socialist and Bernie Sanders a communist. She's a politician in the worst sense of the world. A wealth tax is nonsensical, but you signed the giving pledge. I literally don't understand that. You signed the giving pledge. Now, I don't know what Warren's policies are in terms of the wealth taxes and ongoing ones. I don't know. We can start with a 2% hit right out of the gate because everyone's like, well, the giving pledge is just one time, man. Estate tax is just one time. A wealth tax will be perpetual. Well, let's start with the one time. We'll say, okay, we're going to get 2% of your wealth if you have over $1 billion. Whatever it is. And then we can always revisit that if we need. If it kills everything in the markets, we can revisit that and say, maybe that was a bridge too far. I don't know. But why is a wealth tax nonsensical when you're giving half your assets to charity at your death? What do you think charity does with it? You think it just sits there and they hedge? You think they margin? No, they sell it so they can spend it on the salaries of their highfalutin CEOs of the charity. Cooperman agreed wealthy people should pay more in tax, but he questioned what that rate should be. He said 50% is reasonable. All right, The problem with that, with many state and local taxes, we're already past a 50% marginal tax rate. He said, well, you can always move to Florida, Texas, Tennessee, and they don't have that. So he acknowledged that inequality is a divisive problem that demands a solution. His approach is through education, which has been the target of his philanthropy. We need to bring more people into economic prosperity, ideally through education. We need faster growth to absorb the growing population and solve inequality. He has donated $25 million to fund a scholarship program for 50 inner city children in Newark. His graduate, or whatever. The country is moving left, he said, and will do so more quickly if Biden wins. This is what's funny. He said he's an independent, but recently changed his registration to a Democrat in order to support Bloomberg in the primary. Cooperman is not happy with the president's, the candidates in the race. All right, so yeah, you're shocking. He's shocking. He's going to support another multi-billionaire. That's nuts. All right, so look, man, whatever. This guy's nuts. But he's rich. You know, he gets more say than you and I do. And as always, the right needs to learn how to get their pitchfork sharpened to make these people like this, instead of donating to non-government organizations all over the world, but to donate in here. Now, he wants to get $25 million. That's great, but he's worth billions, man. Billions. So anyway, bonds are that had nothing to do with bonds. The weirdest article. All right, we'll see. Oh, actually, hold on a second. I do want to show you something. I'll do another video on this. Oops.